Eric, we begin this second week of May with oil prices trending downward. You've been rather bullish on crude. Does this change your forecast at all?
No, I think what we're seeing now is a collapse in the financial demand for oil temporarily. What I care about is the physical demand for oil, and that remains very strong. Obviously, we've got regional lockdowns in China. To me, it's really short-term noise. And for an energy investor, our biggest job is to figure out what matters, and everything else is truly noise and can distract you from the multi-year bull call in oil. So what matters? What matters is demand was back to and will once again be back to pre-COVID levels. But most importantly, there's a structural challenge to growing supply, whether it's financial guys saying to shale companies, you will not grow beyond a couple percent, whether it's OPEC exhausting its spare capacity in the coming months, whether it's the global super majors that haven't been investing in 6 to 7 years. So that's really what matters. What matters is inventories have fallen at the fastest pace in history, propelling upwards the oil price. And what took years in the making will be years in the fixing. And the only end result is meaningfully higher oil prices. So a day like today, where stocks are down 7%, what didn't change today? The amount of free cash flow hitting the bank accounts of these companies, the compression in trading multiples resulting from that. And when I look at $100 oil, which seems to be a good floor that is defendable, the average Canadian energy company can privatize and become debt-free with 3.2 years of free cash flow at that level. So oil falling from 100 to like only $106, we are in such an egregiously profitable area where there's a cash flow bonanza. Today's like today, in my mind, are nothing but a buying opportunity to add more exposure.
Let's get into some of those stories that matter, as you say. How much of what's happening in Europe matters to this global energy landscape?
Yeah, so I think people are not seeing the big picture. Sanctions are obviously important. We have the EU meeting to try to phase off Russian imports. That's clearly going to be a very, very long-term process because the oil market was already undersupplied. So you can't magically find 2.5 million barrels, to replace Russian crude. I think the developed world has realized that oil revenue by Russia is being weaponized and it's being used to purchase weapons that is killing innocent kids. So without a doubt, it's important in the shorter term. The real story, though, is here you have one of the largest, or at least former largest oil producers in the world that is going to be starved of capital and starved of technological know-how. No service companies going back anytime soon. No large, super majors going back in the country anytime soon. And so I think there's going to be a gradual erosion as much as 500,000 barrels per day in productive capacity from one of the biggest producers in the world in what was already one of the most undersupplied markets in history. So to me, that's the real story. We've yet to see a real physical impact. There was a surge in exports. That's just everybody knowing that there were sanctions coming. So every possible barrel, you flooded the market. The CEO BP was saying that production, which is what matters, production is down 1 million barrels per day to fall another million. So I think we've yet to see the real impact in the physical market from what's happening in Europe.
Russia is saying that it is seeing new buyers for its oil, specifically in Asia.
Yeah, so there are certain countries whom perhaps do not share our value system where they will be willing to try to offset some of the lost barrels. They're purchasing it at a massive, $35, $37 discount. So it's very, unless, if setting morals aside, it makes strong economics. So you are seeing China and India imports increasing. I don't think it's enough longer term to be able to offset the full impact of Russian sanctions if the EU is serious, if the US is serious, if other countries are serious. And so, yeah, it's going to be a balancing factor. I think net, it further tightens what was already a very, very tight and undersupplied market.
Let's just go back and pick up on some of the things that you had first mentioned. And let's talk about the risks to supply. You had mentioned OPEC's reduced spare capacity. Can you bring in Saudi Arabia into this? Can you bring in Iran into this conversation?
Sure. So what we saw in the month of March, we're waiting on official April data, but in the month of March, 7 of the 10 largest members of OPEC were underproducing their quota. Therefore, they were giving up hundreds of millions of dollars a month of lost revenue. Why would they do that? It's because for the past 7 years of depressed oil prices, when the oil price has been far below what these nations needed to be going concerns, What they couldn't cut spending on was social expenses. Otherwise, people go out into the streets and demand regime change. The easiest thing to cut was productive capacity, investment in productive capacity. And so you're seeing that now. And so it's been years of chronic underinvestment that will take years of investment to further repair. So we're seeing that in Saudi Arabia, underproducing their quota. Iran, it feels like the nuke talks are dead. Even if they were resolved, you're talking about 700,000 barrels per day in a market that's undersupplied by about 2 million barrels. So it's not even a band-aid for a hemorrhage. It would do nothing. And so as bullish as the end of US shale hypergrowth was for the energy markets, once people realize that OPEC is nearing exhaustion of its spare capacity, it will take years to fix that. That's when I think we can really go parabolic on the oil price.
When Russia's war on Ukraine started the end of February and the discussions began on Russia's oil disruption, of course, then the conversation turned to Canada and whether or not we could potentially step in. Has that story changed at all?
The real story is the undervaluation of energy stocks in Canada and the unwillingness of investors, whom we are the owners of these businesses. I run the largest energy fund in Canada, so I'm one of the largest owners of businesses on behalf of my clients. Our message to these companies is you cannot justify growth until your stock re-rates closer back to normal levels. We're actively buying right now stocks trading at 1.5 times their cash flow when they used to trade at 8 times, where they're trading at on an average 30% free cash flow yield. And so you can't justify growth in this environment, even though the market is undersupplied, until stocks meaningfully re-rate, which would mean more than a doubling from current levels. So there is a role for Canadian energy, both oil and natural gas going ahead. But in the near term, at least, the owners have to allow incremental investment. And what we're saying is, given that disconnect in valuations where I can buy decades worth of free cash flow for free because people are energy ignorant and think we're all going to be driving electric cars in the next year. Until that remedies, the owners of the oil businesses in Canada are not allowing them to grow meaningfully.
You've mentioned that that $100 a barrel is the floor, and you and I have talked about what that ceiling might look like in that $180 to $200 a barrel, I guess, forecast. Has that changed at all for you?
Yeah, it sounds crazy. But if you look at the prior high in oil adjusted for inflation, you're looking at about 185. You hear anecdotes of people complaining about the price of gasoline being over $2 in Canada and such. They're complaining, but they're not changing their behavior yet. And so in a market which is structurally undersupplied, where demand will grow for at least the next decade, and yet supply cannot for a variety of reasons, the only balancing factor is then an oil price high enough to kill discretionary demand growth and restore balance. So you've got to the price of gas, for example, has to be expensive enough not just to be complaining, but to actually have an impact on people's behavior, where it's too expensive to take your family to Florida because jet fuel is crazy. It's too expensive to rent an RV and go on a road trip because gasoline and diesel is too expensive. We're not there yet. And that still suggests when oil represents about 7 to 8% of global GDP, that remains an oil price of about $180 per barrel. And so I think we were already going to see that this summer. Then you had the largest SPR release in history that delayed it by several months to quarters. But in my mind, the logic of my thesis is that is the inevitability of where we're heading.